Hello, and welcome to BeLoanReady, qualifying for a home loan. So, you've had a job, and you feel like you're rolling up to the club like this, and you're ready to buy this, but you fear you're only able to afford this. So the question is, how do I know what price of home to shop for? And the answer to that is called prequalification. How does this qualification process work? Before we get into some of the finer points of prequalification, let's state the obvious things you will need to qualify for a mortgage. First off, a source of income, such as a JOB, that can be documented and deemed likely to continue, meaning you can be expected to pull in money and continue this career for some time, meaning you're not like this guy, or pursuing a career in professional vaping. At best, it's a hobby. A hobby. You're contributing as much as a fog machine at an alternative magic show in Vegas. Okay, sorry. Anyway, you will also need to have established a FICO score that shows you are a reliable credit risk. Be sure to check out our video on this. And in addition, you will need to show that you have some assets that help your cause, like money in the bank, retirement funds, stocks, bonds, money things. Alright, now let's go behind the curtain. The Consumer Financial Protection Bureau states that the home price you can afford depends on 4 key factors: how much you can pay monthly, how much you can pay upfront for a down payment, the kind of loan you get, for example a 30-year fixed, 30-year adjustable, 15-year fixed, etc., and the interest rate and terms of your loan. Now let's take these 4 items and dig a little deeper. How much can you afford to pay monthly? All mortgage lenders and financial institutions will look at 2 ratios in helping you understand what you can afford. They are a housing ratio. This is the amount of your monthly housing expense divided by your monthly gross income. Your total debt-to-income ratio. This is all of your monthly debts such as car loans, student loans, credit card payments, your mortgage payment, and other installment loans divided by your monthly gross income. Please note, a good rule of thumb is to keep your housing ratio at 28% or less and your total debt-to-income ratio at 41% or less. How much can you pay up front for a down payment, plus closing costs? This will depend on what liquid assets or cash you have for a down payment. The minimum down payment required on the majority of home mortgages will be 3.5% to 5% of the sales price. If you have 20% to put down on a home, you will avoid the need for private mortgage insurance, or PMI. Please see our video, PMI vs. Hazard Insurance, for more details. Loan type. Many loan types and terms exist, but a general rule of thumb is the longer the term of the loan, the lower your monthly housing payment will be. This is because you have more time to pay the obligation back. Keep in mind, the longer the loan term is, you will be paying more money in interest over the life of that loan. Adjustable rate loans may offer you lower interest in the beginning, saving you money, but when they adjust, you are susceptible to interest rate swings that could increase your payment substantially. Interest rates. This one is easy. The lower the rate, the lower the monthly payment. So, in short, a lender will take a look at your ability to repay the loan back. They will look at your ratios, a function of income and debts. They will look at your assets, and they will look at your credit report to make sure your FICO range is acceptable and you have not had any derogatory credit issues that hinder your ability to repay the proposed loan. Also, they will run the numbers on the loan term and type of your choice. If all this looks A-okay, you will qualify. I know it seems a bit daunting, and even scary, but BeLoanReady and an arrived mortgage mentor will always take the time to explain and guide the process to reduce the stress and confusion. Thanks for watching, and see you in the next video.